Central banks bought more gold in the last 2 years than at any point since 1967. They know something. And it isn't just about gold, because right now, hidden behind all the noise about gold hitting record highs, there's a second metal sitting coiled like a spring, waiting. A metal that has historically exploded whenever gold runs hot. And almost nobody in mainstream finance is talking about it seriously. Stay with me, because by the end of this video, you'll understand exactly why silver, yes, silver could reach $200 an ounce before the end of next year. And more importantly, what you need to do about it. Welcome back. If you're new here, this channel is dedicated to one thing: protecting your wealth from a system that is quietly working against you. Today, we're diving deep into what may be the most underpriced asset on the planet right now. While the headlines scream about gold at record levels, smart money, real smart money, has been quietly positioning in silver. And the setup we're looking at today is unlike anything we've seen in decades. We're going to cover the fundamentals, the technicals, what's happening at COMEX, what the central banks are doing, the supply crisis that's developing in real time, and we'll walk through 3 specific scenarios for where silver goes from here. This is not hype. This is analysis. Let's get into it. Let's start with a number that tells you almost everything you need to know: the gold to silver ratio. Right now it sits around 85 to 1. That means it takes roughly 85 ounces of silver to buy 1 ounce of gold. Now here's the thing most people don't understand. Historically, over centuries, this ratio averages somewhere between 40 and 60. During major precious metals bull markets, it has collapsed to 30 or even lower. In 1980, when silver hit its all-time high of $50, the ratio briefly touched 17. But here's what almost nobody is telling you right now. Every single time this ratio has been stretched as far as it currently is, and then began to compress, silver didn't just catch up with gold. It outperformed gold by a factor of 2, 3, sometimes even 4 to 1. So if gold stays where it is today, and the ratio simply reverts to its 50-year average of around 55 to 1, do the math, silver would need to nearly double from current levels. And if this turns into a full-scale precious metals bull market, the kind driven by currency debasement and institutional panic buying, we're looking at a ratio collapse toward 30. At current gold prices, that puts silver somewhere between $120 and $200 an ounce. That's not a fantasy, that's just math. Now let's talk about something the mainstream financial media almost never covers properly, and that is the structural supply and demand problem developing in silver right now. Silver is not just a monetary metal. It is the most electrically conductive element on Earth. And that means it is absolutely essential for the green energy transition that governments around the world are legally committed to. Solar panels require silver, EVs require silver, 5G networks require silver, medical equipment requires silver. AI data centers, which are consuming electricity at an extraordinary rate and driving demand for new power infrastructure, require silver. The Silver Institute, one of the most respected bodies tracking this market, reported that global silver demand hit an all-time record of over 1.2 billion ounces in 2023. Industrial demand alone accounted for more than half of that total. Now here's where it gets critical. Mine supply has been essentially flat for nearly a decade. Many of the world's largest silver mines are aging. New discoveries are rare and take 10 to 15 years to develop. And here's the part that should genuinely concern you. Approximately 70 to 75% of silver is produced as a byproduct of mining other metals like copper, zinc, and lead. That means you cannot simply increase silver output on demand. It is largely a function of what those other industries decide to mine. Consecutive years, more silver is being consumed than is being produced, and those deficits are being drawn down from above-ground stockpiles. Stockpiles that are not unlimited. This is not speculation. This is what the data shows. Pressure building underground. Now pay attention, because this changes everything. The COMEX is the primary futures exchange where silver and gold are traded in the West, and what's happening there right now is extraordinary. Registered silver inventories at COMEX, that's the silver actually available for delivery, have been declining sharply. At various points over the past year, deliverable silver stocks have hit multi-year lows. Meanwhile, open interest, the number of futures contracts outstanding, remains enormous. What does that mean in plain language? It means there are far more paper claims on silver than there is physical silver to back them up. This is what the big banks don't want you to know. The entire paper silver market has been used for decades as a mechanism to suppress the price of physical silver. Every time silver starts to run, large institutional short sellers, and yes, this has been documented and even resulted in regulatory fines for major banks, pile into futures contracts to cap the rally. But physical demand is now overwhelming that mechanism. We saw a preview of what happens when retail investors and physical buyers pushed back simultaneously during the 2021 silver squeeze. Premiums exploded. Dealers ran out of stock. The paper price was forced higher, but it was only a preview. The pressure building in the physical market right now is significantly larger. And when it releases, not if, but when, the move in silver will be sudden, sharp, and violent to the upside. This is not a market for slow, patient accumulation over years. This is a market where timing matters. Currency debasement cycle. Let's zoom out for a moment and look at the macro picture driving all of this. The European Central Bank has been navigating one of the most difficult monetary environments in its history. The euro has faced persistent pressure. Inflation in Europe, while down from its 2022 peaks, remains structurally elevated in many member states. Real interest rates, that is, interest rates adjusted for inflation, remain negative or barely positive across much of the continent. And that matters enormously for precious metals. Historically, gold and silver perform best when real interest rates are low or negative, because in that environment, there is no cost to holding a monetary metal. It doesn't pay interest, but neither does your savings account in real terms. Meanwhile, across the Atlantic, the Federal Reserve is caught in its own trap. U.S. debt has crossed $34 trillion and is accelerating. The interest payments alone on that debt are now the single largest line item in the federal budget, exceeding even defense spending. The political pressure to inflate away that debt, to print money and debase the dollar, is enormous. And here's the critical point that ties it all together. When central banks around the world are simultaneously buying gold at record levels, as they have been for the past 2 years, they are sending a message. They are voting with their own reserves against the long-term integrity of paper currencies, against the dollar, against the euro, against all fiat money. Silver is the people's version of that trade, and the people are starting to figure it out. Now, let's look at what the charts are saying, because this is where things get very interesting. Silver spent nearly 4 years building a massive base between approximately $18 and $26 per ounce after the 2018-20 COVID spike. That consolidation, which technical analysts call a cup and handle formation, is one of the most reliable bullish patterns in technical analysis. The wider and longer the base, the more powerful the breakout tends to be. We have seen silver breach and hold above its previous multi-year resistance levels. The key technical levels to watch are the 2020 high near $30, which has now been tested and at points exceeded, and the all-time nominal high around $50 set back in 1980 and briefly revisited in 2011. If you apply Fibonacci extension analysis to the current pattern, and again, this is a tool, not a guarantee, the measured move targets for this cycle project to a range of $100 to $180 at minimum, with an extended target that touches or exceeds $200. Volume analysis supports this. Every significant pullback in silver over the past 18 months has been bought on high volume. The institutional accumulation pattern is clear to anyone who looks at the data without bias. The momentum indicators, RSI, MACD, relative strength versus gold, all support a continuation of the current move higher over the medium term. 3 scenarios for silver. All right, let's be honest with each other. Nobody knows the future with certainty. What good analysis does is lay out the possible scenarios, assign realistic probabilities, and help you make an informed decision. So here are 3 scenarios for silver over the next 12 to 18 months. Scenario 1, the conservative case, 35%. Probability: in this scenario, the broader economy navigates a soft landing. The Fed manages to hold rates higher for longer without triggering a recession. Demand for silver remains strong from industrial sectors, but the monetary and investment premium doesn't explode. In this environment, silver grinds higher, perhaps reaching $45 to $65, driven primarily by industrial demand and the supply deficit. The gold-silver ratio compresses modestly to around 65 to 70. This is still a very solid return from current levels, but it's the measured slower outcome. Scenario 2, the base case. 45% probability. In this scenario, which I personally view as most likely, we see a combination of factors converge. The Fed pivots toward rate cuts as the U.S. economy slows, real interest rates fall, the dollar weakens. European capital seeking protection from a weakening euro and continued political instability across the continent flows into hard assets. Simultaneously, industrial demand continues to outpace supply. COMEX inventories fall to critical levels, forcing price discovery in the physical market. Silver in this scenario reaches $90 to $130 per ounce within 18 months. The gold-silver ratio contracts toward 50. This is the scenario that rewards investors who position now rather than waiting for confirmation. Scenario 3, the bull case. 20%. Probability. And then there is the scenario that seems extreme until the moment it isn't. In this scenario, a geopolitical shock, an escalation in existing conflicts, a major currency crisis, a sovereign debt event in Europe or emerging markets, triggers a global flight to safety. Simultaneously, physical silver demand spikes as retail investors, pension funds, and family offices pile in simultaneously. In this environment, we revisit the dynamics of 1980, a short, violent parabolic spike. Silver reaches $150 to 200 plus. The gold-silver ratio collapses toward 30 or below. This is the scenario that creates generational wealth for those who are positioned ahead of time and devastating regret for those watching from the sidelines. 20% probability is not negligible. A 1 in 5 chance of a tenfold return from current levels is an asymmetric opportunity that sophisticated investors take very seriously. Let me bring this all together for you. The case for silver right now is not built on one factor. It's built on a convergence of multiple independently powerful forces, all pointing in the same direction at the same time. You have a structural supply deficit that is not going away. You have record industrial demand, driven by an energy transition that governments are legally committed to. You have a gold-silver ratio stretched to historically extreme levels, with every historical precedent pointing toward violent compression. You have central banks buying gold at 50-year record rates, signaling a crisis of confidence in paper money. You have COMEX-registered inventories being drained. You have technical breakouts confirming years of accumulation. And you have a macroeconomic environment, negative real rates, currency debasement, geopolitical instability, that has historically been the most favorable possible backdrop for precious metals. The question is not whether silver will move. The question is whether you will be positioned when it does. Now, a word of caution because this is important. Nobody can guarantee a price target. $200 silver requires the bull case to play out. That is not certain. What I can tell you is that the risk-reward of silver at current levels, against the backdrop I've just described, is among the best I've seen in this market in years. If you are a European investor watching the euro lose purchasing power year after year, if you are an international viewer concerned about dollar weakness, inflation, and the long-term stability of the financial system, silver is worth serious consideration as part of a diversified wealth protection strategy. Physical silver, coins, and bars from reputable dealers gives you direct ownership with no counterparty risk. Silver ETFs and mining stocks offer leverage but come with additional risks worth understanding separately. Do your own research. Consult a financial advisor if needed, but do not ignore what the data is telling you. If this analysis added value for you today, if it made you think differently about what's happening in these markets, then do me a favor. Hit the subscribe button right now and turn on the notification bell. Because when silver starts to move in a serious way, you will want to be ahead of it, not reading about it after the fact. Drop the word silver in the comments below. Let me know you're watching, and let me know which of those 3 scenarios you think is most likely to play out. And share this video with one person, just one, who you think needs to hear this information. Because this is the kind of analysis that doesn't make it onto mainstream financial television. It stays in corners like this one. I'll see you in the next video. Stay informed, stay protected,